What is going on, investors? Hopefully, you guys had a great day out there. Time to talk about FedEx Corporation, ticker symbol FDX. They just reported their Q4 earnings, their year-end earnings after the bell today, and the stock is dropping a little bit. Okay, when we get over to the stock chart, we'll see this one's shedded off about 2% here. After reporting these earnings, it's actually pulled right into an area of demand. So we'll talk about, is this a buy the dip opportunity with FedEx? Can you wake up on Friday or even next Monday and buy shares of this on the dip? We'll talk about that. Now, of course, we are going to go into the numbers. We'll take a look at the revenue, the profit. We're going to get it from a 3-month basis and a 12-month. We'll get the full year of 2021, at least their fiscal year over at FedEx. And we'll compare them just really quickly to UPS as well. What I wanted to show you, though, right off the top is that FedEx, inside their report, they gave guidance for capital spending of $7.2 billion this upcoming year. Now, in a vacuum, $7.2 billion doesn't mean a lot to you. So what you want to do is come down to this cash flow statement, which we'll go into a little bit more detail later in the video. But here's our year-end cash flow statement. Right-hand column is 2020, last fiscal year. Left-hand column is the most recent fiscal year, 2021, which just ended as this report was released. You come down here to capital expenditures, and you notice over the last 2 years, last year was $5.8 billion, basically flat this year as well at $5.8 billion, and I told you they were guiding to $7.2 billion. That's a cool $1.4 billion more on that side. So it might have some investors worried a little bit, and that could be one reason for the pull-off, since it does affect valuation when you are going to expend this much money. The other thing that is interesting is as FedEx falls or goes up and vice versa, UPS does the same. And here's evidence of that. I've just got kind of a traditional valuation metric. I've got price to sales here. UPS is in the blue line. FedEx is the orange line. And you see here that UPS always trades at a premium to FedEx. Whether or not it should be that way, I don't know. I'll let you decide. But the thing that holds true is UPS tends to trade at 2 times more sales than FedEx. Like at the most recent hour, UPS is trading at 1.98, essentially 2 times sales, and FedEx is sitting right there at 1 time sales. Now, there's been times the spread has been wider. There's been times where the spread has been a little bit more compressed. But in general, these two stocks trade together. And so if you like the drop in FedEx, you might like the drop in UPS as well. So those are some things to keep in mind as we roll through these numbers. Now, speaking of the numbers, I'm going to zoom all the way back up here to our financial highlights. This was for the fourth quarter and the year ended. The year ended is the right-hand column. But I tell you what, we're going to do most of our work here in this last column here. So we've got our revenue here on the top line. The right-hand column is last year. The left-hand column is 2021. This percentage is the percentage of increase. And I tell you what, you're looking at FedEx Express growing 32%. FedEx Ground grew 27%. The freight segment grew 38%. The service segment 14%, and others grew 17%, but it's a pretty small number. But overall, blended total revenue grew 30% over the last year on a quarterly basis. And if you look for a yearly basis, you grew 21% from $69 billion up to you call that $84 billion on the 12-month. For the last 3 months, you went from $17 billion up to $23 billion. Now, one of the reasons why on this channel, we don't talk about micro cap companies. We don't talk about penny stocks. We don't talk a lot about a lot of up-and-coming stocks. And it's not because I'm lazy. It's not because I don't want to or I don't have an interest in these companies. But you got a mega cap company with essentially, they have more competitors than one, but they essentially, this is all as close to a duopoly as you can possibly get. I know there's USPS, there's XPO, there's other freight forwarders and things like that. But essentially you don't, and there's Amazon now these days. There's not a lot of competition in this business, and they're growing at 30%. Why would you want to dig around in these micro cap companies and take all that risk when mega cap companies are growing at 30% on their top line? That's absolutely fantastic. Now, unfortunately, other things are growing over at FedEx. Maybe they're feeling a little of that inflation. Salaries and benefits up 24%. Purchase transportation, 24%. Rentals up 20%. Depreciation, amortization, non-cash, not necessarily something you'd worry about. Here's the big one, fuel. Look at this, 81%. Hello. Now, notice for the full year, the 12 months, it actually declined. But in the most recent quarter, obviously, you can go to the gas price and look at it now. The oil and gasoline price at the pump has just surged. And FedEx has not been immune to that as well. You've got maintenance and repairs also up, but just blended. Total operating expenses, keep in mind, in the quarter grew 23%. But, I say but, when you grow your total revenue by 30%, that is probably going to lead to very, very nice bottom line numbers. We'll get to those in a second. Now, again, I told you for the full year, we grew 21% on our revenues. Our operating expenses, again, for the last 12 months grew 17%. So they're probably going to flow some nice money down there, minus some taxes and things like that. So here's our operating income by segment. I like that they give it to you per segment. Look at some of this growth rate on this operating income. 118% on the express, 64% on ground. Look at the freight, 173% operating income. Again, that business unit on the revenue side grew 38%. They grew operating revenue or income or profits, depending on how you look at it, by 173%. So our total operating income for the last 3 months grew 278% from $475 million up to, we'll call that $1.8 billion. Just absolutely phenomenal growth. And that is potentially why FedEx came out and says, hey, we're going to spend $1.4 billion more on our capital expenditures, buying trucks, buying, everything that they need to build up their business, is because they're seeing a trend like this where you're growing your operating income by 278%. For the full year, you grew at just 142%. Again, we don't cover a lot of micro cap companies on this channel because you're growing revenues for the full year at 21%. You're growing your operating income at 142%. And this is a $75 billion company that pays a small dividend, 1% yield on this one, but you're getting $3 per share on this one. And then look, from a price to earnings basis, if you want to take a look at this from a valuation perspective, you're only paying 16 times forward earnings. Put that in your small cap portfolio and smoke it, guys. It doesn't get much better than this. Okay, now we've got to pay some taxes. They've got some retirement income expenses, or sometimes it's realized as a gain. You got income taxes down here. You got some other stuff, but you come down here to net income, which is not a figure I often come all the way down to. I tend to focus on the operating side and gross margins. They don't necessarily break it out here, although you could determine those, but I tend to focus on revenue growth and operating income. But I tell you what, you come all the way down here, the net income on this one, and you grew, just a massive number, because they actually were negative on the net income last quarter at $334 million. This year, they turned positive at $1.8 billion. That's probably going to make cash flows absolutely phenomenal. And you see here for the last 12 months, you went from $1.2 billion up to $5.2 billion net gap net income. Okay. This is going to make, I'll tell you right now, when you see 300% growth on the net income, that's going to make cash flows look absolutely phenomenal. We'll get to that in a second. We'll take a pit stop here at the balance sheet. You got the assets on the top line here. You got cash and cash equivalents, and you got some receivable as well blended together. You got $7 billion in cash. Last year, you had about $5 billion. You got another 11, call that 12 in receivables. Some of that you might not collect all of that, but you'll probably collect a lot of it, maybe 11 of it. So you got about $18 billion in essentially cash. You could probably borrow off those receivables. All things being considered, looking absolutely phenomenal. On the debt side, we do have some long-term debt, less the current portion. That actually ticked down just slightly, about $1.2 billion. So they increased cash, increased receivables. Assets grew quite a bit, in fact, over the last year, and long-term debt actually ticked down, liabilities up just marginally. All things being considered, that's looking really good to me. Now we come down to cash flows. I talked about, here's our year ended for cash flows, so they give you a 12-month view on the cash flows. Here's our 2021 on the left-hand column. I talked about how we pull down this just incredible net income number. Okay, we just pulled down $5.2 billion. Last year, we were sitting at about 1.3. So we get to pull that down. So we pulled down 1.3 last year. Here's our $5.2 billion. We pulled that down. We get to add back in depreciation. A company like this has lots of depreciation. Think about it, on all their trucks and all their equipment. All that gets depreciated over a period of time, okay? And so that's not cash, okay? They had to pay for those trucks. They're either leasing them or a combination of owning it versus leasing it. Well, they get to depreciate a lot of that stuff. And I know FedEx runs on a franchise model, so to speak, but they still experience a ton of depreciation, okay? Probably airplanes, all those types of things. They are experiencing a lot of that. That gives us net cash provided by operating activities. We get to add back and subtract some other things. Take a look. I talked about how that was going to be fantastic for the cash flows. When you pull down $5.2 billion, take a look. Cash flows from operations, $10.1 billion. Last year, you're sitting about half that at about $5.1 billion. That is just phenomenal, just incredible. Okay, and so here's our capital expenditures, and this is maybe what management is seeing, that they're going to be able to maybe, and again, I'm putting maybe words in management's mouth, but my guess is they think they're going to be able to print this type of net income number. They're going to be able to print maybe not quite this great of cash flows, but similar type cash flows. So it's going to allow them to spend more on those capital expenditures, because we talk about here, last year it was at 5.8, this year, or 5.9 rounded up. This year, 5.9 again. This coming year, $7.2 billion on those. And so we will spend a little bit more money there. More money will flow out there. Now, what's interesting, though, is we are payments of debt. So here's our financing activities. Last year, we paid $2.5 billion on our debt, but we withdrew. Here's our proceeds from debt issuance. We withdrew 6.5, so netted out, that's about $4 billion. This year, we went the other direction, okay? We paid $6.3 billion and we drew down about 4.2, so equaled out, that's about $2.1 billion that they paid down on their debt. We saw evidence of that when we were looking at the balance sheet. So all things being considered, looks like about $2 billion flowed out of the company from that sense. But so here's how cash flows work, okay? You've got your investment activities, this 5.8 plus some other stuff. You spend about $6 billion investing in the business. You spend another $2 billion, we'll call it paying down debt. That's $8 billion. Well, look, you printed $10 billion. Yeah, $10 billion to the operating side. So that gives you about $2 billion and some change that goes right to the balance sheet, which we saw evidence of that as well. We saw that cash and cash equivalents ticked up by about $2 billion. So this is how you can kind of back into these numbers, okay? And you can take what you learned here in this FedEx video, and if I don't do a video on that company, well, you can take what you learn here and then back into these numbers by combining a little bit what you learned here on cash flows, backing into it here on the balance sheet, but also taking in mind what we see here on the profit and loss statement as well. Now, moving over to the stock chart. This thing, here's the thing that is uncommon about FedEx is a lot of stocks have done what FedEx does, especially a lot of the tech stocks that we follow pretty closely here on the channel. So I'll reset this graph. So a lot of stocks made this March like knee-jerk reaction, traded down, and then everybody realized, oh, wait a second, everybody's going to be staying home and ordering packages. And look at this. FedEx went from $90 in March to, we'll say the bottom of our range, $240 in, oh my goodness, that was 6 months. 6 months, it went from 90 to 240. I mean, it's just incredible. This is why I don't invest in a lot of microcap companies, because you can have moves like that. Again, maybe that's a once in a lifetime type thing or once in a decade type move. But here's what happened is we pulled forward a ton of gains. And what's happened with FedEx is exactly like what we've seen with Facebook and Apple and Amazon and a lot of well-known stocks, is now we're waving sideways. And here's what I notice about this. Okay, we were waving between 240 and up to about 290 on this one. And we waved there and then we broke up above it just in, it looks like April or end of April, early May. Actually broke above this. And if you've been following this channel or follow technical analysis, when you break above all-time highs, well, that's a pretty bullish sign. And it came up here and it hit its head. It looked like sellers step in on about 318, 319 on this one. And then it sells off. But it really just came back and retested this 290 area. And that's exactly where the stock is trading right now in the after hours, right at 291. And so here's how you can think about this, okay? Are we in a new trading range with FedEx? So what I want you to think about is if this 290 level is now the new kind of bottom of our trading range, well, I think we could bounce back up to 320, maybe potentially come back down, then eventually go back up. It could be that we're in that type of move with FedEx. The other thing that I'm seeing here is this shorter term uptrend still completely intact, okay? You have an uptrend here, and now you're kind of pulling back to where the trend line is. You could draw this trend line in a number of different ways. You could scoot it up here if you wanted to. You're basically pulling back down to it, retesting it, and the momentum of this stock, in my opinion, still looks okay. Now, here's the other end of the scenario, okay? Let's just say we break this 290 level and we start coming down. Well, we'll start retesting areas inside this box of consolidation, okay? I think the first logical stop for this stock could be down here at 270. I think that would be a buying opportunity. Further down, I think home run, absolutely home run buying opportunity. This one all the way back down, retesting these areas of consolidation, not necessarily all the way back down to 240 where this line is drawn in, but I think you'd actually have a spot right here at 250. Okay. So I'd watch this one, okay? If you want to get into it, if you want to add to your shares, whatever it might be, you like the dividend, they certainly have room to, they have a ton of room to grow this. When we talked about how they have an EPS of next year between 20 and a half and 21.50, okay? This is their EPS. And they're paying shareholders $3. Yeah, they have a little bit of room there. They probably could increase the dividend. So if you like this from that sense, or whatever the reason you have here, you're monitoring this 290 level very closely. And if you break down below this, I think you have opportunities here at 270 and really at 250 and certainly at 240 as well. And I'd like to say, look, if FedEx is pulling back, guess who else is probably going to pull back? UPS, and you come take a look at that one as well. We'll certainly cover UPS when they report their earnings in a short period of time as well. Hopefully you guys had a great day out there. You enjoyed this video. We'll be back again soon with more. Good luck with your investments.